All right, so today I wanted to do something that I've never done before, and this is if I could only own 5 stocks or ETFs, which ones would they be? Now, there's a couple caveats that I wanted to throw out before I get started. The first one is this is more of a growth portfolio example. I think I'll make one with strictly dividend ETFs/stocks. And the other one is this is assuming that I'm buying right now. Because there are some stocks that if they were trading at more of a discount, I probably would change things up. Maybe 1 or 2 of these I would change out. But given how expensive, like I don't think I can think of a single stock that I would consider to be like very undervalued right now. So that's why I'm going to stick with mostly ETFs to make this video. But those are the caveats I wanted to throw out. So I also wanted to mention, as usual, if you get value, please like and subscribe. Check out the links below. So the first one is the QQQ. This is obviously the NASDAQ ETF. And the long and short of why would I choose this? Well, it's very simple. It historically has outperformed the S&P, right? I mean, going back almost to 20 years, you're looking at about 2.5 times the return of the S&P. Even if we go back, let's go back about 10 years, you're still looking at almost double. Even if we go back about 5 years, still has outperformed by about almost 30%. So that's why I like the QQQ. Obviously, this is an ETF. And the other reason I really like it is this is the second most liquid ETF or stock when it comes to options, which I really like to do because options, whether it's puts or calls, is an easy way to reduce your risk. And on top of that, if you do it consistently over time, you'll actually increase your returns as well. So that's why I like this. There are ETFs that I arguably could put above this one. SPMO is the one that comes to mind there, but there is some other ones. But the problem is the option trading volume on some of those is either non-existent or very small. So that's why I like the QQQs, right? Trading options, like I said, whether it's selling calls or puts, is an easy way to get an extra, 2, 3, 4% per year, which again, do that over 20, 30, 40 years, that is an insane amount of money. So that's the first one. The next one is going to be SPY. Now, SPY and QQQ, there's a lot of overlap, right? There's obviously a lot of overlap, but they are different, right? They are a little bit different. The main reason, again, for having this one in the list is this is the most liquid ETF or stock. This is the most liquid product as far as options go. There's daily, there's weekly, there's everything. Now there is for the QQQ as well, but I believe the SPY trades. It's still significantly more options volume than even the QQQ does. So that's why I hold this. And at the end of the day, you're getting the market return, right? And not only that, like I said, if you trade options, you're actually going to get a little bit more. So that's why I like it. And honestly, in a market that's super expensive, to me, that like going to cash doesn't make sense, right? People look because a concern that way too many people out there aren't taking into account is inflation, right? People say, "Oh, you're getting 4% on T-bills," and it's like historically inflation runs at about 6 or 7% per year, so you're not actually making money, right? And this is something that people just can't seem to get through their heads. So you really need to be invested. I'm not necessarily saying fully invested. Obviously, there's risks with investing, but to me, going to cash makes no sense. So let's get to the next one here. The next one is going to be MSTR. Now, again, I've talked a lot about MSTR, so I won't go into a crazy amount of detail here. But the long and short of it with MSTR is I believe that of all the stocks in the market right now, MSTR is the best risk versus reward. Now, again, the one thing I'll throw out there is it comes with a lot of risk, right? This is one of the most volatile stocks out there. So don't think that it's going to be a straight line up, because I mean, look at this chart here, right? Look at this chart. I mean, we've had, you know, crazy amounts of volatility here, but at the end of the day, over the last 5 years, it's up over 3,000%. The S&P is up 170, right? So this is why I really like MSTR. I think that expecting to get a 3,000% return over the next 5 years certainly is too much. It's unrealistic, but I still think it's going to beat the S&P. I think it's going to beat the NASDAQ, and on top of that, you can use options to increase those returns. And again, notice the pattern here. So this is the third one, and I really like it, right? I really like it because, I mean, they have more than 10 times the Bitcoin of any other company out there. And that's something that people are slowly going to catch on to, like, hey, like this is a thing of beauty, and it's really going to perform well because of that. Now, again, there's a lot of people out there that think that, oh, well, you know, why should it trade above its MNAV, right? And you know, Michael Saylor's answered this question a million times, but the long and short of it is, publicly traded companies can do things to increase returns that IBIT or other ETFs cannot do. And speaking of that, right, I mean, one of the ways is STRC, or another option that, honestly, STRC and STRF, these ones are literally like a 50-50 for me. I like them exactly as much, but I'm going to choose STRC here simply because the yield is a little bit better right now, and this one pays monthly. STRF pays quarterly. Not that at the end of the day there's that much of a difference, but again, if I'm stuck on the fence, because at the end of the day, STRF is higher in the capital structure, so theoretically it's safer from that point of view. But on the flip side, STRC, MSTR is quite literally designing. So if the price is below $199, I think, maybe 98, they're going to increase the yield above 9% to get people to buy it. And if it goes above 101, they're going to start buying some back in an attempt to get people to sell it. So this one, essentially, they want, like, MSTR is literally trying to keep it around $100 a share, which means you're going to get that guaranteed 9% dividend. And on top of that, the chances of you losing money on that investment as far as share price returns go is very low. It certainly is possible, right? It certainly is, but it's very low. With STRF, it has had better, it certainly could have better price returns, but it could also have worse price returns. So they both have their pros and cons. I chose STRC for the you know, it has more price stability and it pays monthly. STRF theoretically is higher on the capital structure, so it's better in that sense. It's better in that if you can get it at par, you're going to get a higher dividend, but it's significantly above par right now. So that's why I chose STRC here. And this one is a little bit different because this, number one, you get that 9% return, which is amazing, right? It's a guaranteed 9%. Who isn't interested in this? And the other reason I chose this one is on years when the market is down. Like, I mean, there's going to be years where the S&P is down, 20, 30%. That's going to happen at some point. You're still getting that guaranteed 9% return on here. So that is going to provide a lot of downside protection, right? When MSTR, there's going to be years where it's down significantly as well. You're going to have that downside protection. Now, on years when the market's up 20, 30%, okay, you're going to underperform. But the reason I like this is that you're getting that guaranteed return. And the last thing I'll touch on here is that this is what makes MSTR special. Not only do they have by far the most Bitcoin, they also have these products that are going to provide them a steady stream of a guaranteed way that they're going to be able to increase their Bitcoin stack without having to issue shares of MSTR to do it, without even having to take on debt to do it. So that's why I like MSTR so much and STRC. And the last one here is, I had to throw in an international fund here. IDMO I went with. I also like EFA. This one has a fairly solid options market, but IDMO has outperformed it by quite a bit, so that's why I'm going to choose IDMO. And the reason for this is I think that a lot of people in North America, not in the rest of the world, but in North America, are overexposed to their home markets, right? I mean, I see this in Canada as well. Like, if you're Canadian, like I see people that literally like they have like 50% of their portfolio in Canadian stocks or ETFs, and that is just absolutely insane. It's absolutely insane. Number one, because the Canadian market is almost always underperformed the U.S. market, and even to some degree the international markets, at least some of the markets. And on top of that, the dollar is underperformed. Now, again, there's no guarantee it'll do that over time, but also the economy is weaker. Like, so again, for the fellow Canadians out there, I really don't know what you're doing there, but I like this because. And another thing to point out too is a lot of the international ETFs that people hold, they still have like a 50% weighting to the US markets, which again, if you're going to hold an international fund, make sure it's actually an international fund, right? So if we go into this one, Japan is the top holding 25%. The US isn't even in the top 10. So yeah, that's why I like that. I mean, the US is 2%, right? So it's completely negligible here. So, if we look at this one over the last 5 years, it's actually slightly outperformed the S&P. And this is something that a lot of people don't really realize, is that they think that, the US market is always going to destroy the international markets. And it's like, there's no guarantee of that. There really isn't. Now, I still believe the U.S. market is better, but you also have to keep in mind that the U.S. market is clearly overvalued right now, right? So that's why I definitely would be including an international fund in here. It's just a no-brainer, right? It really makes no sense not to. This one has performed very, very well. And I mean, if we go back 5 years here, I mean, if we let's check its historical, its yield on cost is, I got to go back a little bit more there. Going back 5 years, almost exactly, 3.4%, right? So not only are you getting whatever price returns you're going to get from the ETF, you're also getting a 3.4% dividend yield, right? Which is pretty sweet. I mean, that's more than you're going to get for a lot of GICs and CDs nowadays. So that's my 5 fund portfolio. Like I said, I'm going to make one on strictly a dividend portfolio, because I think that the way you invest, if you're strictly investing for dividends, is different than if you invest for growth. Now, technically, if you invest for growth properly and you do it over a long period of time, you don't necessarily need to switch to dividends, but that's too complicated for the average person, so I'm not going to get into that. Like I mentioned at the start of the video, please like and subscribe, check out those links below, and stay tuned for more.